It's Tuesday, September the 2nd, which means another segment of 2 trades in 2 minutes, where I try to find you 2 high probability, low risk trade setups that you can take. And today, both of these are going to be in the metals sector, and I will tell you why. Now, this morning, markets gapped down just a little bit. As of right now, the S&P, the NASDAQ, and the Dow are all down 1.25%, 1.5%. And the news is something that came out on Friday. Core CPI numbers were released. This is the core consumer price index, basically the inflation number. And it came in at 2.9%, which is nowhere near as crazy as it was back when the government had the printing presses running full speed. But it's a little bit higher than the Fed's 2% target. And right now, the market is all about interest rates. Market soared last week after Federal Reserve Chairman Jerome Powell spoke at the end of the Jackson Hole Symposium, basically changing his tune, saying, we believe it is time for us to reverse course, i.e. start cutting. So the market priced in a near 100% certainty of a rate cut in September and continued rate cuts through the end of the year and especially into 2026. This core CPI number, which is the Fed's preferred metric, came in a little bit hot. It's not crazy, but it's not down as low as they'd like. It's a slight uptick from the previous month. It's the highest number we've seen since February. And so what happened is over the long 3-day weekend when no one could do any trading, they come in scared, markets gap down a little bit. But not everything is falling off. And if we take a quick look at the market health area, you're going to notice a pretty clear theme here. Now, the home building sector, which we've been looking at, still in play. None of those stocks are running today with the fear of interest rates not coming down quicker, but still very much strong. But look at a lot of the areas we're seeing strength here. We have the mining and metals sector. Mining and metals, mining and metals, mining and metals. Clearly a move to physical assets, commodities. Also the lithium sector, electric vehicle, which includes a lot of lithium. A lot of this has to do with mining and physical assets. And I think what we're seeing is fears that inflation is not so tamed. It is going to ramp back up. Stock valuations are getting pretty high. And I think we're just seeing some dollars flow to these hard commodities, specifically the metals, steel, gold, silver. And so that's where I want to focus today with the 2 trades I want to show you. So let's set up a 2-minute timer and begin. Now our first stock is Alcoa, the aluminum firm. You can see, let me take the moving averages off here because I've drawn out a pretty clean shallowing breakout pattern. Thought we'd want to break out here. Now the stock is down about 5% this morning. One of the reasons we really want to wait for confirmation that this stock has broken out, that it gets above that resistance. But there's really 2 ways to play this. One is you buy it off the moving averages here. You kind of cheat a little bit and say, all right, well, if I were buying the breakout, I want my stop right down in here. That's really the danger zone for this. If it gets below there, I'm no longer bullish. So I'm going to take advantage of this dip. I'm going to kind of preload the gun. I'm only going to risk about 5%. And then if it breaks out and runs, I've already got a 6 or 7% profit. So it allows you to get in really tight. Obviously, the win rate on these is going to be a little bit lower than waiting for a breakout, but it's a way to get in early, not risk as much money, and just sort of gamble a little bit on the moves. You're getting in low in the base. The other way is, of course, just to wait for the breakout. For me to be a move above 32.5. If I did that, assuming today's the low, I'd put a stop here at about 30.10. So it would be a buy stop at 32.50 with a sell stop order at 30.20 for a breakout higher, and I'd be targeting somewhere in the neighborhood of about a 20% move higher. Now, the other stock is not even a stock, it's an ETF, and that is gold, GLD. Most of you by now know that I've been super bullish on gold ever since this breakout in early 2024. It was a super clean move right back in here. You can see it on the chart. This is about a 4-year pattern. There's also about a 15-year pattern. You step way back, but it's really clean breakout. Beautiful move higher. But now it is compressing again. And as we zoom in, we see the same thing. Exactly. We will look for strong move up, shallowing, tightening, compressive action. Breaks out today to a move higher. I think you can buy gold here. I am bullish on it over the long term. You could also use a shorter term stop, risking about 5 to 5.5%, looking for a move over the next 3 to 6 weeks higher. Now, I failed to get this done inside of 2 minutes. What's new? But one more thing I want to show you about gold, and I don't think this gets enough attention, is the correlation between Bitcoin and gold. Now, gold has been stagnant for a lot of years, and a lot of people say the reason is Bitcoin is the new gold. Those hedge dollars go to Bitcoin instead of gold. In fact, I saw something the other day I couldn't believe. More Americans own Bitcoin than gold today, which is kind of crazy. But there is an inverse correlation between Bitcoin and gold. So if we just look at two charts here, I'm going to put Bitcoin on the top. Let me just delete all this stuff off the chart here. And I'm going to put gold on the bottom. What you'll notice, and it's not exactly 1-to-1, but it's pretty darn close, is that typically when Bitcoin is running, gold is not, and vice versa. So if we look over here, let me get my cursor synced up here. If we look over here at when it runs, this is when gold was running here, okay, from 1,600 to like 2,000. Bitcoin going nowhere, right? When Bitcoin finally starts taking off in here, look at gold, pretty much flat. Bitcoin flattens out, gold goes for a run, right? Gold running in here, Bitcoin dead flat. Bitcoin finally gets running here in late 2024, gold is flat. And again, it's just interesting because typically when one of these runs, the other either goes flat or pulls back. And I mean, look at here, right about almost to the day when gold topped is when Bitcoin started running. And then we had this pretty strong run up into here. They've both been getting quiet. And look what's happening now. Again, Bitcoin is on top, gold's on the bottom. Bitcoin has been falling off, and I talked about this in Friday's email, how I thought we'd have a really clean breakout over here. It started out strong and then just really fizzled. And during that same period of time, look what's happened with gold. It's been putting in this big consolidation base down here on the bottom, shallowing, compressing, absorbing that supply, just tightening up like a coil spring, getting ready to go. And that really is pretty much on par with what we normally see. A big run, a consolidation, a run, consolidation, run, consolidation. So again, there are no guarantees, but when I'm looking at this, all the stars kind of align. We got some fear in the equity market. We've got fear in interest rates. We've got Bitcoin rolling over. And then we've got gold coming out of this really, really clean, shallowing breakout pattern higher. Everything's down today. Gold's up a full % and rising. So I think it makes a lot of sense to put some money in gold here. I've talked about this before. I've got about a quarter of my retirement dollars mixed between GLD, which is gold, and GDX, which is the gold miner. So the mining stocks are going to be a little bit more volatile simply because if gold goes up 20%, their profits are going to go up 40 or 50. And so if you see a 30% up move in gold, you probably see a 60% up move in this and vice versa. But I like to spread it around a little bit. But very, very bullish on gold right here. So anyway, long way of putting this. The two trades I'm looking at, GLD, I think it's very much Bible right here. Only need to risk 5 or 6%. Hopefully you get in to what I believe is the beginning of a very, very strong super cycle. I think we'll see $7,000 to $8,000 an ounce over the next couple of years. And then the other one, Alcoa, two ways to play it. One is buying here on the dip, trying to get in low in the base, work your way into a position, maybe getting a half position here, adding the other half when I break above 32.50. The other is, if you're not so sure, just stay patient, put a buy stop order at 32.5, wait to buy it till and if it breaks above this level for another move higher. So that's my two trades, nowhere near 2 minutes. One day I'll make it work, but if you haven't already, hit the subscribe button down there in the corner so you don't miss these videos. And I'm going to make an in-depth video on the Gold Supercycle later this week because I think there's huge opportunity in a multi-year trade both in gold and in silver. And there's a lot of history to this that most people do not know. I'm going to go into the gold to silver ratio, the Hunt brothers squeeze of gold back in the 1980s and why it's taken 45 years to get back. What I see as upside targets, I think there's going to be 200, 500, 1,000% gains made in these metals over the next decade, and I want to lay it all out for you. So be sure, hit the subscribe button, and I'll tell you all about that later this week.